Okay, our highlight with NVIDIA this week might be overshadowing some other fun news and action in tech, including Crowdstrike earnings, as the market looks to assess any fallout, any damage from their big mess up. Joining us from Wedbush, Taz Koujalgi is Managing Director of Equity Research covering Crowdstrike. Taz, welcome back to the show. So is there any obvious tone for this earnings? Is this like a time to try and make peace with the market? Or are we going to see some real fallout from clients?
Sure. So I think if you look at the buckets of exposure to CrowdStrike, there are two risk factors here, right? One is the risk of them getting sued by the customers, liability claims. The second risk is what happens with existing customers if they leave the platform or if they go to another vendor. We think the first bucket is fairly low risk. I don't think, given the user agreements that they have with their customers, the risk of getting sued or risk of getting damages against CrowdStrike is pretty low. The risk of new customers coming on the platform remains high, though. We will see how long it takes for customers to get the confidence back on the platform and how long it takes for new customers to get back on the platform. So that's the main risk that we think we have to factor in.
Okay, so the user agreement prevents them from getting sued. You think that's ironclad? That's a good defense for now?
We think so. If you look at the user agreements, I think they have a lot of protections against how much they can be sued for, what are they liable for. So when we spoke to legal experts and attorneys on what CrowdStrike could be hooked for, we were told that the likelihood of them getting sued for a big amount or going bankrupt or whatever, the extreme case is very minimal. The agreements protect them from liability damages beyond a certain point, and they have cyber insurance which should cover some of that. So the risk of claims and damages against CrowdStrike seems pretty minimal at this point.
Okay. What about customer drop-off? How many other options are there if you were really burned and you're real bitter about what happened? Are you switching to a different client? Can you? Is anyone as good as CrowdStrike? I mean, there's options, right?
Sure. I mean, there are options in the market. There are customers who are, when they buy CrowdStrike, they evaluate other vendors before they buy CrowdStrike. So there are options for customers to look at. There are companies like Palo Alto, which offer endpoint security and cloud security. Companies like SentinelOne offer similar products. So there are options for customers. But again, it takes a long time to rip and replace an existing software. And that's not just true for CrowdStrike, it's true for any software. Once you've had a software for a few years, your customers, your users are trained on that software, your IT guys are trained on that software. So I think ripping and replacing is possible, but I think it's not easy. The bigger risk is for new customers who are coming on the platform. If they decide to pause and go to some other vendor, that's the bigger risk. I think existing customers staying on the platform, leaving is a low risk in my view.
You mentioned SentinelOne with earnings tonight. Shares are up like 45% since the last earnings. Would we get some detail from their report possibly? Like if a competitor shows some big uplift, is it a zero-sum game at this point? Could we conclude anything?
I think it's a zero-sum game probably in the longer run, not near term, because when customers let's say a customer was looking to buy CrowdStrike and he pauses now, he decides, I want to wait and see what's happening with CrowdStrike. I don't want to sign on that line, on that contract today. Let me evaluate the option. So a customer pausing a CrowdStrike deal would not immediately go over to another vendor and sign on that line. So it takes time to evaluate and go through the whole sales cycle. So I think it's a zero-sum game eventually, but in the near term, let's say, it's been a month and a half since this happened. I don't think any loss to CrowdStrike in the near term would translate to a gain for a different vendor in the near term. Eventually, yes. Customers were supposed to go to CrowdStrike, for whatever reason decide not to go to CrowdStrike and decide to go to somebody else. That's a zero-sum game. But I think any customer that decided to pause on a CrowdStrike deal in the last 6 weeks is not going to go ahead and sign a new deal with a new vendor right away. So I think it's not a zero-sum game in the near term.
What about the marginal new customer that they need to acquire to keep up their 20% plus annual growth rate, basically, for recurring revenue? Does it limit any potential for guidance? Might they have to reduce their expectations for their rate of revenue growth if this has kept anyone at bay?
I believe so. I think that's the biggest risk. So like I mentioned, the risk of existing customers leaving the platform is pretty low. I'm sure some customers will look at leaving the platform, but the bigger risk is new customers coming on the platform. That has slowed down. We've done checks with with partners and customers, we've heard that a slowdown, but these things take time to play out. So I think in the near term, we might see risk to the new business that they're supposed to add, which will impact their overall growth and could impact the guidance for the upcoming quarter and for the year. So we will see risk. I think there's a risk to the guide. When they announce the numbers tomorrow, we could see the guide being below where the street was modeling, and we could see a risk to the guide that was previously issued by the company for the full year. So that's on the table for sure.
Okay. You've got $350 price target on it. So at the end of the day, you don't think this is going to be a hugely damaging event for the moment, and maybe some kind of small changes to guidance, it sounds like basically. That's kind of in your realm.
I think structurally the story still remains intact. So I would not dispute the fact that there's a risk to the guide for the October quarter. They'll announce the July quarter tomorrow, and then they'll give the guide for the October quarter tomorrow, and they'll update us on the full year guide as well tomorrow night. So I think there's risk to those numbers, and these things take time to play out. We've seen this with other companies that have gone through breaches and have had issues where it takes 3 to 4 quarters for customers to come back to the platform, get that confidence back. So there's a near-term risk to the numbers, but I think structurally the story still remains very solid. One of the best companies in the cybersecurity space, one of the best platforms. The feedback from customers has been good even after the outage. These things happen. It's not something which was done intentionally. It's unfortunate, but it was not something that was. It was not a breach. It was an IT outage. Nobody suffered any kind of data loss or any kind of breach. So it is still doing what it was supposed to do. I think it's a near-term headwind to numbers, near-term headwind to sentiment, but structurally, I think the story still remains intact. We'll see the numbers recover maybe by the middle of next year, and that should get the story back on track.
Understood. Okay. Thanks, Taz. Appreciate that. Good analysis set up for us. $315 price target on it. Tom White, let's trade. You got 2 different approaches here, so let's go. Bullish first.
Yeah, I mean, you got to look at the implied volatility levels, really elevated going into this report. And they should be, right? Plus or minus 9% move, over $23 either way they're expecting. I mean, we could see a 2 or 3 standard deviation move easily on this one.
Sure, if there's any big surprise.
Yeah, take that into consideration, especially with guidance moving forward and commentary from the company. But looked at this 2 ways. First one, a little bit more bullish, sets up with Taz's price target about 315 to the upside.
Conservative, by the way. The street's average is 340.
Is it?
Yeah.
Yeah. So, yeah, and those are all come down, because there were a lot of price target above 400 before the outage. So I looked at the first one, a little bit more aggressive, taking advantage of a high implied volatility in the near-term options and that dispersion that we talk about into earnings events or market-moving events. So looked at a call diagonal. I'm going to go out to the September monthly cycle, so 24 days till expiration. I'm going to buy a slightly in the money call, the 260 call. It's got the higher delta. It reacts more like the stock. And then against that, in the August 30th weekly options that expire in just 3 days, sell the 290 call. So bullish, $30 wide call diagonal on this one to the upside. Bullish in stance. That 290 strike that you're selling in the August 30 weekly cycle sets up with about that 1 standard deviation move to the upside. You're paying roughly about a $15.50 debit for a $30 wide call diagonal. So there's the bonus, right? That you're risking a lot less than the width of the call diagonal, and that's because of the implied volatility dispersion, where you're buying about a 67% implied vol in the September options, selling about 131% in the near-term August 30 options. If you pay $15.50 debit, your break-even's around $265, maybe a touch higher. But you can see here from the risk profile, everything above that break-even is going to be potential profitability. And then also, because you're paying less than the width, the profit graph does not go down above that 290 strike. You're still going to have a nice profit on that, a double on this. But I think the key is, as you get closer to expiration in the next 3 days, hey, if it goes up to 280, 275, 295, you can start rolling that short option if you want, that collects credits, or you can just close the trade if it's a nice winner for you.
True. All right. Generally, the higher it goes, the better you do.
Yep.
Okay. I like the calendar component, though, too. Gives you a little flexibility. Been noticing that on the tech trades this week. That's the approach you like. So given the vol kind of pumped up in a lot of these names beforehand.
And remember, you can do them to the downside, too. You can do bearish put diagonals, too, if you think a stock's going to fall.
Okay. So bullish call diagonal.
Yeah.
How about something if you are a little bit less convinced that they're going to make it through this unscathed?
you can still take advantage of that high implied volatility, but a little bit more conservative. So I looked out in that September monthly cycle, so 3.5 weeks till expiration on this one. I'm just going to sell an out of the money put vertical for that neutral to bullish stance. Selling the 245 strike put, buying the 235 strike put. Show a short $10 wide, neutral to bullish put vertical. You're collecting roughly about a 290 credit on it. Might be a little bit lower than that. But the credit you collect is what you can make on it. But you can see here, if I collect 290 credit, takes my break even to just above 242 to the downside. That's over 8% below the current share price in CrowdStrike. So this one, same directional bias, right? But I still give myself that cushion, better probabilities of success by selling the 245, 235 put vertical for neutral to bullish stance.
Okay. All right. So in this case, just collect a little bit and hope the thing doesn't make a huge move.
Yeah.
Okay. All right. Nice. I like it. Still, though, a generally bullish position betting against a big sell-off.
Right.
So, all right. 2 ways to get exposed to CrowdStrike going into the report. Thank you, Tom.